taking a look at Doge. The last time we talked about Doge, we talked about us entering Doge when it broke 57 cents. I'm pretty sure all of you can recall something to that effect if you read those if you read those messages in the group chat where everybody was downloading different exchanges, making sure we can buy up Doge. So we talked about Doge breaking 57 cents the last time we talked, but the market has changed. Elon Musk has been running around being Elon Musk. We can just leave it at that. And now I'm gonna get into the reasons why Doge could be looking up, right? So the first thing that I want to point out, right, don't worry about all this. I'm gonna clear some of this stuff up that you're looking at on this chart, and so I can make it make sense, okay? So the first thing that I want you to take a look at on Doge is let's take a look at the MACD. The MACD is a momentum indicator, right? And I just want you to have a look at the histogram, right? You see this negative momentum? Right, this is selling pressure. Think of it like selling pressure. You see the sell pressure, right? The negative momentum is starting to ease. It's making a higher low. You see this low is higher than its previous low, right? So keep that in mind. And you also got this bullish cross on the MACD as well. So keep that in mind. Now let's take a look at price. You see how this lines up in the same moment of time, right? At the highest level of this negative momentum, all the way up here. So let's take a look at price. You see on price, you have consecutive lower lows, right? This low is lower than that low. This low is lower than that low, and so on. This low is lower than that low. This low is lower than that low. So whenever you have lower lows on price, and then you have higher lows on negative momentum, that's called Class A bullish divergence, right? Bullish divergence, right? That means the price and the momentum is diverging, right? So whenever you have that, you have bullish divergence and bullish. Think about bullish, meaning going up, right? So you have that Class A bullish divergence, and that's the strongest type of bullish, that's the strongest type of divergence that you can have on any asset in any market, right? Class A bullish divergence on the MACD. Let's take a look at the RSI. This is the relative strength index, another momentum indicator, right? Let's look at this oscillator. Here you have the same thing, right? You have higher levels of relative strength, right? You have higher levels of strength, momentum, right? And on price at the same point here to here, right? Look at here, it lines up here on the RSI. And let's go here from this point to this point, you have a lower low on price. So that's the same thing. That's Class A bullish divergence on the RSI. So on both oscillators, you have Class A bullish divergence. Again, that's the strongest type of divergence you can have on any asset in any market, right? So Class A bullish divergence. And remember, when you're sizing up charts, it's just like going to court. You got to present the most compelling argument to back up your claim, right? You can't just say Keenan stole my car. You got to have sufficient evidence to support that claim that I stole your car, right? You got to have anyway, I'm not gonna get into that. You all get that. And so now let's look at the price chart. Here on the price chart, you have this beautiful Gartley pattern, right? And you can do your research on Gartley patterns. If you want to screenshot this and Google Gartley patterns, and you will see exactly what I'm talking about. So you have this beautiful Gartley pattern, right? And on this Gartley pattern, it's suggesting like price targets all the way up here at 56 cents. But I'm going to take a little bit more of a conservative approach. I'll get into that in a second. So you have this beautiful Gartley pattern, right? At the pattern completion zone, which the entry was at 25 cents. Was at about 25 cents. That was the entry, but we missed it, right? So now we're going to keep developing our thoughts, and then we're going to find another entry, right? So you have this Gartley pattern. That's number 3. That's evidence number 3. And then let's remove this Gartley pattern. I hate to do it because it's so pretty. And now you have price breaking out of what's known as a fallen wedge, right? Fallen wedges are also bullish in nature and could be signaling a reversal. You can Google all this stuff in your own spare time if you like to, just so you can understand what I'm saying. So you have price that's starting to break out, right, of this fallen wedge, which is bullish in nature and signifies a reversal in price. So those are 4 things. That's enough for me to go ahead and start planning my entry. If you are really risky, right, you feeling really froggy and you just want to jump, you could enter here, but that's highly risky. Why? Because you have to, let's extend this all the way back here, right? You see at this same level, this was Doge all-time high back in back in April, right? Around about April the 16th, Doge made this all-time high. As you can see, once Doge reached to this level, it got rejected. It broke it here momentarily and got rejected again. And the next time it broke it, it went and made all-time high. So now over here, you have this resistance, right? And you still have price fighting to get above Doge's all previous all-time high all the way back from April the 16th. So you could get risky here and go ahead and enter, but no, it needs to break Doge's previous all-time high and to continue to see this thing have a markup in price. So that's why I'm suggesting to wait until price breaks 41 cents, because let's take this line all the way back here, right? That's that last high that it made before retracing. And once price, as you can see here, got above that, it was off to the moon. So I'm taking a more conservative approach, right, where you can manage risk a little bit better by waiting to enter until price breaks 41 cents. And then let's talk about percentage. Let's talk about targets and how much you can earn on your investment if Doge continues to move to the upside, right? And also, by entering here, you will be entering right here. Let's get this accurate. By entering here, you'll be entering once price gets above this 200 moving average, right? The 200 moving average always acts as support and resistance, so you want to wait for price to get above that. So if you waited to the 41 cents, you'll be entering once price got above that 200 day, right? So you'll be even more in the clear of price going in the direction that you want it to go. So let's take a look at your entry and your ROI. So if you waited to enter until price got over 41 cents, you won't see any resistance until here, right? And that's where price could reverse, because you see what happened the last time when price hit this level. It sold off, right? So you won't see any resistance until price get here, and that'll be a 21% increase ROI on your initial investment. And the same thing, and the next real resistance level is here where traders settled up right here, and that'll give you 36%, and all the way back up to here, and that'll be 58%. So if Doge does continue to appreciate, that could be your entry at 41 cents, and we could be looking at possibly increasing your investment by 58%. So if you go in with $100, you could be looking at $158, right? That's an awesome return. So that's what I'm looking at on Doge. That's the sentiment. Remember, you got those four things. You got Class A bullish divergence on both oscillators. You had that very beautiful Gartley pattern, and you have Doge breaking out of a falling wedge. All bullish indicators signaling more upside for Doge. But peace. That's my sentiment on Doge. Didn't take very long to develop that. I think that means I'm getting a little good. Not going to toot my own horn, but I just broke that down pretty well. Peace. I'm out.